The U.S. economy is on the move, and the latest GDP figures are here to tell a fascinating story. A 3.8% growth in the second quarter of 2025 has everyone talking, but there's more to it than meets the eye. Let's dive in. The growth primarily stems from a decrease in imports and a boost in consumer spending. However, it's not all smooth sailing. Investment and exports took a hit, partially offsetting these gains. Here's where it gets controversial. The initial estimate was revised upwards by 0.5%, mostly due to an increase in consumer spending. But why the revision? Well, that's the part most people miss. It's all about the data. New and revised information from the Census Bureau's Quarterly Services Survey and Ward's automotive unit sales played a crucial role in this update. From an industry perspective, private goods-producing industries saw a 10.2% increase in real value added, while private services-producing industries grew by 3.5%. However, government value added decreased by 3.2%. The price index for gross domestic purchases also increased by 2.0% in the second quarter, with the PCE price index rising by 2.1%. Excluding food and energy prices, the PCE price index increased even more, by 2.6%. Now, let's talk about profits. Profits from current production increased by $6.8 billion in the second quarter, but this is a downward revision of $58.7 billion from the previous estimate. The annual update of the National Economic Accounts provides an even broader perspective. It covers the period from the first quarter of 2020 to the first quarter of 2025, and the reference year remains 2017. The updated estimates show that real GDP grew at an average annual rate of 2.4% from 2019 to 2024, which is the same as previously published. For the first quarter of 2025, real GDP is now estimated to have decreased by 0.6%, a slight revision from the previous estimate. This is primarily due to downward revisions in investment, government spending, and exports, which were partially offset by an increase in consumer spending. And this is where the story gets even more intriguing. Real GDI, which is the average of real GDP and real GDI, is now estimated to have increased by 0.2% in the first quarter, a significant upward revision from the previous estimate of a 0.1% decrease. The leading contributors to this revision were corporate profits and compensation, based on updated data from the Census Bureau and the Bureau of Labor Statistics. So, what does all this mean? Well, it's a complex picture, and it's up for interpretation. Do these figures paint a positive or negative outlook for the economy? What do you think? Feel free to share your thoughts and interpretations in the comments below.